Hello, investors! Recognizing chart patterns is a way investors can use past price action to predict future market moves. In this video, we're going to take a look at chart patterns investors need to be able to recognize to maximize profits. We'll look at examples of real price movement and how investors' psychology impacts it. There are two main types of patterns investors need to be able to recognize: reversal and continuation. Reversal patterns show a period when buyers or sellers run out of steam and price action changes direction. There are two types of candlesticks that can possibly show a reversal in trend: the bull hammer and the shooting star. A bull hammer candlestick forms when there's an influx of sellers during a price decline. Then, buyers come in and push up the market near the opening price. This causes the candlestick to have a long tail and a small body. Bull hammers that form near buying zones are a good indication that price action is about to reverse to the upside. Shooting star candlesticks are formed when there are a lot of buyers pushing up the price, only to have sellers take over and push down the price close to where it opened. This creates a long tail above the body. Shooting stars close to resistance is a sign price action will reverse to the downside. Let's take a look at some examples. This is a daily chart for a stock that is in an obvious uptrend. As you can see, it is making higher lows and higher highs. The stock is in the middle of a pullback. It is about to enter the buying zone. Investors should be on the lookout for indications of a reversal at this time. Let's get a closer look. The daily chart is on the left. The 5-minute intraday chart is on the right. Remember, the stock is having a pullback toward a known buying zone. The market opens for the day. The sellers are in full control, but price action is nearing a buying zone. Buyers have stepped in and reversed the downtrend. Notice how it is making higher lows and higher highs. The stock closes very strongly. Look at the long tail left behind. This is a legitimate reversal candle. If there is follow-through the next day, that could be considered a confirmation of the reversal. Let's see what happened the next day. There was buying pressure from the very beginning. Notice how most of the candlesticks are green. Notice how there are more red candlesticks now. We're approaching a level of resistance. The stock closed near the high of the day, producing a long green candlestick. Long green candlesticks that open near the low and close near the high are called full-bodied candlesticks. Full-bodied candlesticks have little to no tails. They indicate strong buying pressure. The opposite is true for long, red full-bodied candlesticks. They represent strong selling pressure. Let's go back to the daily chart. Notice the bull hammer created by buyers buying at the buying zone. The long, green, full-bodied candlestick the next day is confirmation of the reversal. An aggressive investor would buy when the stock entered the buying zone. A more conservative investor would wait till there is confirmation of the reversal. Being able to recognize the basic reversal pattern can result in investors choosing the right time to enter an investment. Let's take a look at the daily chart for Home Depot. It had made a very large move to the upside. Investors and traders should be anticipating a reversal. Let's get a closer look and see what happens the next day. The buyers are in full control at this point. This is a full-bodied green candlestick, but here come the sellers. By the end of the day, the sellers have taken over. Notice the type of candlestick left behind. A long tail above the body after a huge move to the upside can be an indication that the trend is about to reverse to the downside. Let's go to the next day and see if there's any follow-through selling. This is some serious selling pressure. The reverse in trend has been confirmed. Notice the long, full-bodied red candlestick left behind. This usually means there will be additional selling pressure. Let's see what happened the next day. As expected, another day of selling. This is why being able to recognize reversal patterns is important for investors and traders. The huge move to the upside combined with the shooting star was a warning that there was about to be a sell-off. Let's take a look at another type of reversal pattern. This reversal pattern is called head and shoulders. The head and shoulders are a very recognizable pattern that predicts a reversal to the downside. It consists of two shoulders, a head, and a neckline. The neckline is an important part of the pattern. If price action breaks below the neckline, it is expected to make a bigger move to the downside. The price action made a move to the downside as the pattern predicted. Another type of reversal pattern is the double bottom. The double bottom pattern happens when price action tests a level of support twice before completely reversing to the upside. The double bottom confirms that there are enough buyers at a level to reverse the trend to the upside. The opposite of the double bottom is the double top. A double top is formed when price action tests resistance twice before reversing to the downside. The double top indicates that there is a sufficient number of sellers at this price point to turn the price movement downward. Let's take a look at some continuation patterns. Continuation patterns happen when price action consolidates after a big move and then exclusively breaks out in the same direction. One of the most profitable continuation patterns is the bull flag. The bull flag pattern is formed when there's an aggressive move to the upside. Then a period of sideways consolidation. Then a huge breakout. Let's go back to right before the breakout. It is very important that investors realize what is going on when price action is in a tight range. Price action is in a tight range when sellers and buyers are at an equilibrium. Once price action breaks out of the range to the upside, buyers with the fear of missing out rush in and buy. Short sellers who don't want to lose more money have to buy to close their positions. So, there are two groups of investors buying at the same time. This is what causes a huge breakout. The opposite of the bull flag is the bear flag. A bear flag forms when there's a big sell-off followed by consolidation. Then another big move to the downside. The situation is the opposite of a bull flag. After price action breaks to the downside, buyers who don't want to lose money sell to close their positions. Short sellers who want to make money as the price goes down sell to open their positions. There are two groups of investors selling at the same time. This causes a bigger move to the downside. Investors also need to be able to recognize triangle-shaped patterns. There are several types of triangle patterns. This is a symmetrical triangle. The consolidating price action creates a triangle shape. Once it gets to this point, there's an aggressive breakout to the upside. Here's a descending triangle. Notice the downward sloping trend line at this point. Either it is going to break support and make an aggressive move to the downside, or it will break the downward sloping trend line and break out to the upside. This is an ascending triangle. Notice the upward sloping trend line, then the breakout. Recognizing these patterns is critical to the profitability of investors and traders. If you find this information valuable, please like and subscribe to the channel for more content on investing.